tell me your name. Feels like you got a lot.
Know the basics of accounting, its definition, the journal entries, and the preparation of the financial statements. Our next step is to go into another field called the financial accounting. But our topic for today would be the easiest one. It is presented under the asset, and it is a current one, and is always presented first in line under the asset. It would be called the cash and cash equivalents. So cash is a medium of exchange that a business needs in order to pay its liabilities. A business can generate a cash from sale of service, sale of asset, borrowings from creditors, etc. Every business also keeps a small amount of cash called the petty cash fund, and it is used for the day-to-day expenses and keeps a larger percentage of cash at its bank. So our next question would be, what are cash equivalents and its difference to cash? So, cash equivalents are not precisely coins and banknotes, but are marketable securities of very short-term maturity, which means having maturity of less than 3 months. These are highly liquid and financial instruments that are so near their maturity, and there's no risk of change in value due to fluctuations. So how do we measure the cash and cash equivalents? It is always measured at its face value, which is also its fair value. Here are some of the examples of cash and cash equivalents. We have the cash on hand, which are undeposited collections of bills and coins, the customer's check, the manager's check, the traveler's check, the money orders, etc. We also have the cash in bank, which includes the deposit in the bank, which are unrestricted for withdrawal. We have the petty cash fund for current purposes. For cash equivalents, we have 3-month treasury bills, 3-month time deposit, 3-month money market instrument, or commercial papers. Sometimes we could also encounter a bank overdraft. So what is it? It is a credit balance in the cash and bank account that results from the issuance of checks in excess of deposits. It is presented under the current liability, and it may be offset between the bank and the depositor. A company's post-dated check is also considered as a current liability because the company's check has been recorded and issued, but there's no actual payment yet as of that date. Sometimes a bank may also set a compensating balance, that it is the balance which the company agrees to maintain in a bank checking account as a security for a loan by the depositor. But are there times that a cash is not considered a current asset? Yes. Sometimes a cash is legally restricted, but it still depends on the nature. If a cash is set aside for long-term specific purpose, such as the bond sinking fund or the plant expansion fund, then the cash will be presented under the non-current asset. Well, that's it for today, Accountaholics. Next time, we'll try to answer some problem-solving questions, so I'll see you soon.
Drink till we're